Sandra had done everything right. 32 years as a school administrator in Ohio. A traditional IRA worth $420,000. She met with her financial advisor every single year, reviewed her portfolio, adjusted her contributions, updated her beneficiaries. Her advisor told her the same thing every time. She was on track. What her advisor never once mentioned, not in any of those 32 years of annual meetings, was a 4-year window. A window that is open right now. A window that could move tens of thousands of dollars completely out of reach of the IRS, permanently. A window that closes in 2028 and does not come back. Sandra turns 73 next year. She found out about this window 6 weeks ago. She missed most of it. This is not a complicated strategy. It is not a loophole. It is not something that requires a special accountant. It is a tax window that the federal government built into the law, and then left entirely up to you to find. I've watched retirees pay $800, $1,100, over $1,400 a year in taxes they didn't need to pay for decades, because nobody sat them down and explained what was available to them in the years before their 73rd birthday. This is for informational purposes only, and not financial, tax, or legal advice. Please consult a qualified professional for your specific situation. My name is Robert. Your guide to the retirement tax strategies the IRS doesn't advertise. If you're finding this helpful, hit subscribe right now. Robert covers the retirement tax topics your advisor might not be telling you about, and he posts new videos every 2 days. Here is what I'm going to walk you through today. I'm going to walk you through exactly what the Roth conversion window is, and why the math works differently in these specific years between 63 and 73. I'm going to explain the 2028 deadline, why it exists, what created it, and what happens to your tax picture the moment it expires. And I'm going to show you the one mistake that wipes out the entire benefit of converting, a mistake most advisors never warn you about, and exactly how to avoid it. Let's start at the beginning. If you have a traditional IRA or a traditional 401k, you have a tax bill sitting inside it. Every dollar you contributed went in pre-tax. Every dollar of growth inside that account is pre-tax. And every dollar you take out, whenever you take it out, gets taxed as ordinary income in the year you take it. At 73, the federal government stops letting you decide when to take it. That is when required minimum distributions begin. The IRS calculates how much you must withdraw each year based on your account balance and your age. You do not have a choice about this. The money comes out. You pay tax on it. For someone with $400,000 in a traditional IRA at age 73, that first required distribution is roughly $15,000 to $16,000, on top of Social Security, on top of any pension income, on top of any part-time work. That stacked income is what pushes retirees into higher tax brackets. It is what makes Social Security taxable at 85%. It is what triggers IRMAA, the Medicare surcharge that adds hundreds of dollars per month to your Part B premiums. The traditional IRA grows. The tax bill grows with it. A Roth IRA works differently. Every dollar inside a Roth grows tax-free. When you take it out in retirement, no tax. No required minimum distributions at 73. None at 75. None ever. The money belongs to you and to whoever you leave it to. The question is, how do you get your traditional IRA money into a Roth without paying a massive tax bill to move it? The answer is the conversion window. And right now, for most retirees between 63 and 73, that window is wide open. A Roth conversion is simple in concept. You take a portion of your traditional IRA, move it to a Roth, and pay income tax on the amount you moved in the year you move it. The reason to do this is bracket arbitrage. You are choosing to pay tax now, at a rate you control, instead of later, at a rate the IRS controls. If you have retired but are not yet 73, you are in what planners call the gap years. No wages. No required distributions yet. Your taxable income is lower than it has ever been in your adult life. That is the window. But something changed in 2025 that made this window significantly more valuable, and that change expires in 2028. The One Big Beautiful Bill Act, signed into law as Public Law 119-21, created what is called the Senior Bonus Deduction. For taxpayers 65 and older, it adds $6,000 per person to their standard deduction. For a couple where both spouses are 65 or older, that is $12,000 in additional deductions on top of the standard deduction they already receive. In 2026, the standard deduction for a married couple filing jointly is approximately $30,000. Add the senior bonus deduction, and a 65-plus couple is shielding roughly $42,000 of income from federal tax before they pay a single dollar. That extra room, that $12,000, is direct space for Roth conversion at a 0 or 10% rate. The senior bonus deduction expires after 2028. After 2028, that room disappears. The space to convert at lower rates narrows permanently unless Congress acts again. This is why 2028 is the deadline. It is not arbitrary. It is built into the law. Here is how to think about the bracket math. In any given tax year, you have a certain amount of taxable income, Social Security, pension, any investment income. You also have your deductions. The gap between your deductions and the top of your current tax bracket is conversion room. Let's use a real example. A married couple, both 68, combined Social Security of $32,000. Taxable portion of Social Security is roughly $21,000 after the provisional income formula. No other earned income. Their deductions in 2026, the standard deduction of $30,000 plus the senior bonus deduction of $12,000. Total deductions, $42,000. The 12% federal tax bracket for married filing jointly in 2026 runs from roughly $23,000 to $94,000 of taxable income. After their Social Security taxable income, they have approximately $73,000 of remaining space in the 12% bracket. That is $73,000 they could convert from their traditional IRA to Roth and pay 12% federal tax on it. Not 22. Not 24. 12. Every dollar they convert now is a dollar that will never face a required minimum distribution. Never push them into a higher bracket at 75. Never trigger more Social Security taxation. Never cause an IRMAA surcharge from an RMD they didn't plan for. The math compounds over years. A 68-year-old who converts $70,000 per year for the 5 years between now and 2028 has moved $350,000 into Roth. At a projected 5% annual growth rate, that is over $450,000 in tax-free assets at age 80, available to them and their heirs without a single additional dollar of tax. Now, here is where most advisors fail their clients, even advisors who recommend Roth conversions. There is a feature of Medicare called IRMAA, the Income-Related Monthly Adjustment Amount. If your income in a given year exceeds certain thresholds, Medicare adds a surcharge to your Part B and Part D premiums the following year. In 2026, the base Part B premium is $185 per month. If your income in 2024 exceeded $212,000 as a couple, your Part B premium jumps to approximately $395 per month. Per person. That is over $2,500 per year extra, per person. Here is the critical detail. IRMAA is based on your income from 2 years ago. When you convert a large amount from your traditional IRA to Roth in 2026, that conversion counts as ordinary income in 2026. Medicare looks at your 2026 income when it sets your 2028 Part B premiums. Convert too much in a single year, cross an IRMAA threshold, and you have eliminated a significant portion of the tax savings the conversion was supposed to create. This is the mistake Sandra's advisor never explained. This is why the conversion amount matters as much as the conversion decision. The rule is simple. Before you convert, calculate your projected income for the year, including the conversion amount. Run that against the current IRMAA brackets. Stay below the nearest threshold, or convert just enough to use the bracket below it. For most retirees in the gap years, the optimal conversion amount is whatever fills the 12% bracket without crossing the first IRMAA threshold. In 2026, that first threshold for a married couple is $212,000 of modified adjusted gross income. Most gap year retirees are nowhere near that number, but it is always worth checking before you convert. An error here is not reversible. A Roth conversion is operationally simple. You contact your IRA custodian, Vanguard, Fidelity, Schwab, wherever your account is held, and you request a conversion of a specific dollar amount from your traditional IRA to a Roth IRA at the same institution. You will owe federal income tax on the converted amount in the year you do it. You can have the custodian withhold taxes from the conversion, but most planners recommend paying the tax from a separate non-IRA account if you have one. Paying the tax from outside the IRA means more money ends up inside the Roth, compounding tax-free. Do it before December. Give yourself time to estimate your annual income accurately and adjust the conversion amount if needed. Do not do it in the same year you take a large capital gain, start Social Security, or receive any unusual income. The bracket math changes every time your income changes. Review the IRMAA thresholds before finalizing the amount. The IRS and CMS publish updated income brackets annually. The relevant number for 2026 Medicare is your 2024 modified adjusted gross income. And document everything. Keep records of the conversion year, the converted amount, and the tax you paid. Your heirs and your future tax preparer will thank you. Most tax strategies for retirees are reactive. You took the distribution, you owe the tax, you look for deductions to reduce it. The Roth conversion window is proactive. You are choosing your future tax rate today, before the government sets it for you at 73. After RMDs begin, you lose that choice. The distribution amount is calculated by the IRS. The tax is owed on that amount. You can adjust around the edges, qualified charitable distributions, timing of distributions, state-level deductions, but the core income is set. The window is the years before that, the years when your income is low enough, your deductions are high enough, and the Senior Bonus Deduction is still in effect, to move meaningful money out of the taxable column permanently. The window is open for most retirees between 63 and 73. It has an expiration date, 2028. Nobody is going to send you a letter when it closes. Sandra is 69. She found out about the conversion window after watching a video very much like this one. She has converted $40,000 in the last 8 months. She paid tax on it at 12%. She will convert more before the end of the year. She will not convert everything. Her advisor, the one she has now, ran the IRMAA numbers with her. They agreed on an annual amount that uses the 12% bracket without triggering a Medicare surcharge. By 2028, Sandra expects to have moved roughly $160,000 into Roth. The remaining balance in her traditional IRA will still require minimum distributions, but the distributions will be smaller, the bracket impact will be smaller, and the long-term tax exposure she passes to her family will be significantly smaller. She told me the thing that bothered her most was not the tax she paid on the conversion. It was the 32 years of annual advisor meetings. The 32 years nobody mentioned this existed. You still have time. The window is open, but it does not stay open. If this helped you, hit the like button. It takes 2 seconds, and it helps more retirees find this information. Subscribe if you haven't already. And if you know someone between 63 and 73 who has a traditional IRA, send them this video. Today, not tomorrow. Today. Drop a comment below. What's your biggest question about Roth conversions? Robert reads every single one, and the most common situations become future videos.